In this short episode, we're going to talk about index funds. Will you make 7% over the long term? It depends on how you define what is the long term. If you're interested in learning more, continue listening. Welcome to the Red to Black podcast with the host Werner and Mario. And today we're talking about index fund. Are you going to make 7% over the long term? That's the question I posed to you, Mario.
Yeah, so it depends on the price you pay. If you're buying it in times where there's extreme panic, extreme depression, extreme pessimism, you can make 7%. You can compound your wealth at 7%. So this thing about index funding where you buy it every month, regardless of price, it's folly. It's foolishness. As the market's going up, not only are you overpaying for good companies, you're overpaying for zombie companies. There's the banks, Citibank. There's all sorts of companies in the S&P 500 that don't make money. They're literally losing money. Multiple corporations in the S&P 500 are junk. So if you're thinking it's a good idea to buy the S&P 500 every month, regardless of price, you're subsidizing junk businesses. You're putting money to work in. People are exiting those shares and they're selling them into these index funds, and then vice versa. The strategy that I recommend or that I endorse is that you wait for buying opportunities and you buy just the quality businesses, the 30% operating margin businesses. You stack up a bunch of cash and maybe you buy two businesses out of the entire S&P 500. You buy Oracle and one other business. I'll leave it up to you, Warner.
So this brings up an interesting point, and I agree with you that we've gotten into this. Before I get to that point, we've gotten into this mindset. I keep hammering this away, is this like Robin Hood. And I wrote an article that I'm about to post on the Red to Black podcast about how we've lost our connection to value in anything in life because everything's supposed to be the cheapest and the quickest. But that's not how everything is. It's kind of a facade. Everything shouldn't be the cheapest and the quickest. It should be what it costs to make, what the value you get from it. That's how you should evaluate anything you buy. So if you're buying everything at the cheapest and the quickest, it gets you on Robinhood, it gets you into index funds, and it doesn't point to what Mario's talking about, which is anything you do, whether it's a car, a pair of shoes, a jacket, the food you're eating, look at it for its value. You want to buy things that produce the best value for you. Like if it's a jacket, pay $400 for a jacket that'll last you 20 years. Don't buy a $200 jacket that you replace every like 3 years and you end up spending more than that $400. Start thinking that way. It's the same thing with business. When you buy a business, think about not like speed and expediency, think about value. And that points me to another point that people will ask is, oh, well, you're buying just two businesses. Are you diversified?
Yeah, so I think diversification can be accomplished with two separate businesses, not 10, not 20, not 50, not the S&P 500, not the Russell 2000, not a bunch of, even within, so there's not only are people diversified within index funds, then they have multiple index funds in multiple different companies. They got Europe index funds, they got Australia and Asia index funds, they got US, Canada index funds. It's too much diversification. Now, I'm not a fan of maximizing the amount of different mutual funds you buy. I don't like index funds really. I prefer to do my own homework and do my own research and buy businesses or invest in businesses or build businesses. I don't particularly want to buy any index. I own no index funds, zero index funds. It's possible to there's a strategy to do this, and it's basically the simplest way is look at the total market cap to GDP of the nation, or gross national product, gross domestic product. They're pretty similar numbers. And when that thing's above like 100%, so you're paying more than 1 times GDP, stop buying the index fund. Don't buy it. Just stack cash. When it's trading, when the entire stock market, the total stock market, so total stock market to GDP or national gross product is less than 1, so you're paying 75% or 90% or 50%. That's great. Start putting all that cash to work. Then you could do that. I'm going to buy every month or every week that index fund until I have no more cash left, and then stop buying it. Let the market come back up. That's a strategy. That's underpaying for the GDP of the nation. You're paying less than 1 times GDP, which is like kind of the top line. 1 times top line. But But just randomly buying the S&P 500 every month, it's pretty foolish.
Yeah, so those are great points. And what this all points to and what this podcast is all about is always putting in the work to do the financial analysis. When people look at a business, whether it's a stock or a private company or real estate, they're just like, oh, I'm going to make money. No, you're going to make money in a high operating margin business that you get for a good price. That takes work. Now, like I said, you can enter at different levels. You can enter an index fund. You could build your own business. You could buy another business. You can enter all these businesses at different levels depending on how much work you want to do. But at the end of the day, it's all going to require sound financial analysis. Now, also one thing that Mario didn't share, which he shared with me in the past, you could buy one company and have diversification. Why? Because the company, like Oracle, is diversified all over the world. Case in point, what happened in the pandemic? Oracle, they're not, I mean, I know well, let's say this, they are raising money from bonds. They're going into these debt markets because they get money so cheap, but they could pay it off. It's not like they're doing it to keep afloat. They're doing it because they're like, oh, this is such great money. I'm going to use this for now, make a return on this, and then exit out of it, give it back to the markets, and then be on my way. They're not worried about it. It's like a little cherry on top of their cake. So what Mario and I are pointing to in terms of index funds, whether it's an index fund, whether it's a business, always evaluate the underlying asset of that business. And the challenge with index funds is how are you going to evaluate all those businesses? See, you're taking risk off of those funds of all these businesses sandwiched together, but you don't know, like, did I buy this business as a good value? Did I buy this business as a good value? Did I buy this business as a good value? You have no idea. You buy one business that's well diversified across the world. It's movable. It's got a resilient brand like Oracle. The pandemic, your bar for the future is the pandemic. Can my business survive a pandemic? I guess the next thing, maybe like a tidal wave, or just start thinking crazier than a pandemic. Can my business survive that? If you find a business like that, that's not coerced by fear or pulled into euphoria, you found a great business.
Yeah, so here's a pro tip for all the gentlemen listening is there's no shortcuts that pay off long term. There's shortcuts that pay off in the short term, but over the long term, there's zero shortcuts that pay off on the long term. You got to do the work. It's a requirement in life to do the work, and that will pay off eventually. When you're skipping doing work and you're putting it on other people's shoulders, you're going to pay that price in the long term. In the short term, you might not. If you get in and you get out, in the short term, you might be able to save a little bit of time and effort if your timing's impeccable. But over a long term, there is zero shortcuts that will pay off in a long term.
Yeah, and case in point is the guy from Archegos, if I'm saying that correctly, Bill Huang, a Korean gentleman, and he worked for, I think, Tiger Capital Management, if I'm saying that correctly. All the hedge fund guys would know. But let's look at his long-term track record. He was nailed for securities fraud, pleaded guilty to it, blew through a bunch of money that Tiger Capital gave him, then started his own fund, lost about, I don't know, billions in a day, either 10 or 20 billion, I forget, in a day. Guys who were looking at his portfolio were saying, hey, he's all he's doing is going long. He's a hedge fund guy. He doesn't have a diversified portfolio in the hedge fund community, which is going short and long. He's making all this money because he's just going long the whole time. Look how that played out for him. He went long on appreciation strategies. 2 times he lost a ton of money. That's what we want you to start thinking about. Is your investments, are you doing it for appreciation or are you doing it for cash flow? Those are 2 completely different things. And that's why we give the example of 7%, because it's not just hold long-term 7%. It's what quality of business are you buying? Mario, any final thoughts? Yeah, thank you so much. And we appreciate our viewers' time.